Okay, so first of all, let me apologize for having to cancel class at the last minute and go to an online format today instead. That's obviously about as late as you can possibly cancel a class. I think I sent the email out about maybe not even an hour before class started. So I hope at least some of you were able to avoid making a trip if you otherwise didn't have to. If not, I apologize. And in the future, hope maybe, obviously to give you more advance notice, but to be able to have some alternative already set up or something. Anyway, I'll just try not to have to cancel class, I guess, in the future. So let's talk a little bit about, we're going to continue on. We already talked about property, plant, equipment, and intangible assets last chapter, in Chapter 10. We're going to continue on with that in Chapter 11. But before I go there, I hope you got my email stating that as far as due dates were concerned, nothing was going to be due officially until a week from today. So I believe that's February 2nd would be the first due date for anything. It doesn't mean that we're not going to move forward before we get to that point, because obviously, Chapter 10 we've already worked through. We're working through Chapter 11. We'll be into Chapter 12 by the time we get to that date. Just pushed the dates back just to make sure nobody, because of tech problems, tech issues, on either end. I know I had some on my end for sure. So if any of you had some on your end on top of that, then it can be more challenging. So anyway, push the deadline back for the first due dates just to make sure everybody's caught up and we're ready to go. So from there, let's move back into, today we're going to talk about utilization of these assets and what happens when they get impaired. Okay. Alright, let's talk about property, plant, and equipment. Generally, obviously, you're going to purchase these with the expectation that they're going to provide you benefits well into the future. That's just kind of their nature, right? And that benefit is usually going to be for, at least a few years, and probably, theoretically up to many years. But specifically, they're acquired or purchased with the idea that they're going to be some part of your general revenue generating operations. So, it makes sense when we think about the matching principles associated with accounting that we would want to match the costs of acquiring the assets with the periods that the assets help to provide benefit in. Cost allocation is the kind of textbook definition for what we're doing when we talk about depreciation for plant and equipment, depletion for natural resources, and amortization for intangibles. And what that is basically spreading the costs of those assets hopefully over the useful revenue generating life of the underlying assets. Okay, let's move on here a little bit. Oops. So that's cutting off a little on the bottom here. Hold on. Okay. Well, you have copies of the slides. I don't want to mess up the presentation and have to go back and start back over again. So if any of these slides, including this one, I can tell you right now, this one's cutting off the bullet that says 4 intangible assets under amortization. So about, maybe a half an inch of the screen is getting cut off at the bottom So if you want to follow along with your slides in hand that are on Canvas, to make sure you're not missing any of those areas where it might be cut off. So let's suppose that a company purchases a used delivery truck, and they pay $8,200 to deliver to, they purchased with the idea that they're going to use it to deliver their products to their customers. So the company estimates that 5 years from the date that they acquired the truck, they'll be able to sell it for $2,200. So given those numbers, $6,000 of the truck's purchase price will be used up or consumed during the 5-year useful life that they are estimating that they're going to have this vehicle. So this is basically just a little pictorial demonstration of that. Measuring cost allocation. Okay, so you see these 3 factors here that you have to have established in order to allocate the cost using either amortization, depreciation, or depletion. You got to know the service life, you got to know the allocation base, you got to know the allocation method. This is the service life. When we talk about the service life, we're talking about the useful life. It's the amount of use the company expects to obtain from the asset before they end up disposing it, either by sale or just by pitching it in the trash. This can be expressed in units of time or units of activity. So like a delivery truck could be expressed in terms of years or in terms of number of miles that the company expects the truck to be able to drive before they have to pitch it or before it completely breaks down. So whenever you hear the word service life and useful life, we're talking about the same things. Just by way of vocabulary, when we talk about physical life, that would be the upper bound, the maximum possible life that you could have for service life. So this is basically the length of time the asset stays in that form. Obviously, the physical life may be different than the service life. The service life could always be less than the physical life, and generally is going to be. So, it just may be obsolete by the time, before it stops actually working or falls to pieces. It just may be so outdated that it's not worth the electricity that it costs to use it. There's any number of things that could cause the asset to still function like it's supposed to, but not have useful life remaining. When we talk about allocation base, this is just, in English, how much are you spreading out over whatever method you're using to break up these payments, or the recognition of this payment. Okay, so if you're using depreciation, this is the dollar figure that you're going to divide up by the total useful life, or that you're going to allocate using the double declining balance, or whatever method you're using. This is the total of what you're going to allocate over a certain period of time. And the way that you calculate that, you take the initial value at the acquisition time, and you subtract out anything that you expect to receive when you dispose of the asset. So if you're throwing it away, that would be 0. If you are selling it, that would be whatever you expect the fair market value in whatever market it is that you're planning on selling it to be when you cross that bridge. So you're given a little bit in allocating these costs over this time period, depending on which type of asset you have. So if you're using depreciation or depletion for a natural resource, you have a little bit of wiggle room in terms of what you use to depreciate this, as far as the allocation method. Typically, what the GAAP guidelines call for is to pick a cost allocation method that makes economic sense. Economic sense, or that has an economic purpose. So, for instance, if we're talking about a fleet of rental cars as the asset, and I'm using number of miles driven as the way that I'm allocating my costs, that would make sense, because that is a pretty valuable metric to look at when the nature of your asset is that it's a car used in a rental car business. So you can, your book breaks this down into either the time-based method or the activity-based method. And the time-based method just means no matter what's going on, even if the car is just sitting in a lot for the whole year and doesn't move, as time passes, you're going to recognize the cost of this asset. So you're going to allocate the cost, I should say, of this asset. That's the time-based method, where just time passes, that's all that has to happen. Or you can have an activity-based method where, like I said, with the rental car fleet, you pick an activity that's related to whatever you're doing, and this is often a favorable approach, because if you pick it as like miles driven for a rental car business, if miles driven is also how you calculate, or one of the metrics you use to calculate your revenue, then both drivers of your costs and your revenue calculation are identical, and you would be very closely following the matching principle, because you would literally be ticking off expense as you count the miles in the same time that you're ticking off the recognition of this revenue. So you are allowed a little bit of leeway in selecting which method you choose, but like that last bullet point there says, you have to pick something that produces a systematic and rational representation. I'm guessing you've all seen all of these in principles. Let's see. Well, I know I didn't talk about some of the year's digits method in my principles classes. I don't think I've ever talked about that in my principles classes. So if you had that with principles with me, you probably have never heard of that, at least. And I actually won't talk about it much, even though your book has it in there this time. For me, in a principles class, basically, when we talk about accelerated methods, there's only one method we're going to talk about, and that's going to be double declining balance, just because that is a common method. But it's the most common by a wide margin when you talk about accelerated methods. So I think it's just a little nitpicky to talk about any other type of accelerated method until you get into, obviously, when you're talking about tax and you have to use the tax-specific requirements for accelerated depreciation methods like makers, obviously that's a different story at that point. But for the most part, I shouldn't say. I think I said I slipped up and said principles before, but I meant to say in an intermediate class, and basically in any accounting class that I teach. Obviously, if you read about some of the other more obscure methods in your book, that's fine. It's good that you have exposure to that. In practice, you will probably never see anything outside what you saw in principles. Anyway, we'll cross that bridge when we come to it a little bit as well. Then obviously we have activity-based methods, and I talked about one right there. It wasn't a units of production, but it was a units of use, a method in using miles with cars. But you could apply it to any activity that's done with the asset that helps to accurately match or allocate the costs with the benefits that they provide. I think you all know how the straight line method works. Here's an illustration of that. You can look at on your own. Just a comparison of some of these different methods. Like I said, you don't have to pay a ton of attention to some of these digits, but double declining balance, units of production, and straight line, you can see how some of the different effects there play out. Obviously with units of production, that is not even remotely standardized and could be literally any configuration of output there that eventually adds up to the $210,000 because that's going to vary completely and could be vastly different company to company as far as even if you have the exact same cost allocation method. I'm not going to talk too much about natural resource depletion. I don't spend a lot of time on it because unless you go into that field, this is one of the hit it and forget it topics on the CPA exam, which you will have to study a little bit for the CPA, but likely will never face in your day-to-day work unless you're working either for a natural resource company or working in an area and specializing in a field that has you working with a lot of people who have business in those fields. And then just having read about it in your book, it's really actually not that complicated to figure out, but you kind of have to pick and choose what you want to go more in depth on in a finite class time period. Like I said, take a look at these. You can see what the journal entry looks like. That alone, having reference to that, will probably help you to answer and allow you to answer any questions that you're asked related to depletion. So obviously there come up some questions about assets depending on what the nature of the asset is. The equipment can be moved from the site and used on future projects. Then the depreciable amount of the equipment should be allocated over the entire useful life of that equipment. If you can't move it and it has to just stay where it is, then it should be depreciated over its useful life or over the useful life of the natural resource, whichever time period is shorter. Yeah, okay, that's all I'm talking about there. Intangible assets subject to amortization. Okay, so first of all, useful life. Legal, regulatory, or contractual provisions often limit the useful life of an intangible asset. On the other hand, the actual useful life of the asset may end up being less than the asset's legal or contractual life. An example of that might be, let's see, maybe the useful life of a patent would be considerably less than its legal life, assuming a legal life of 20 years, if, for whatever reason, let's just say you're in the tech field, let's say you expect it to be obsolete within 2 years. Well, obviously, you get a 20-year patent, whoop-de-doo, if it's obsolete in 2 years, then obviously that's a pretty large discrepancy. And allocating it over the 20-year period that you have the legal right doesn't match nearly as well as allocating it over the period when you have the actual benefit of the asset. Let's see. You can take a look at the illustration on your own. Obviously, if you have any type of asset, and this is again why land ends up not being depreciated, but where there's no foreseeable end to the useful life of the asset, then you don't take any depreciation, and you never change it. You basically never recognize it as a cost. Because you're basically treating it as if you're trading in money for gold, right? You don't want to, you wouldn't want to amortize gold or depreciate gold, because gold in 20 years is probably going to appreciate, not depreciate. And you don't unless you're burning it or using it for something. If you're sitting on it or holding it, you don't use it up, right? So its value lies in its own physical possession. So the same deal with land, right? That's the idea of why you don't depreciate it and it never shows up as a cost. So never ends up, if you trade cash for land, it never shows up as an expense on your income statement, because they say, oh, well, you just, now you have a different type of asset, so we're not going to call that an expense. Same thing here. So we're kind of splitting hairs here, but when we talk about the difference between indefinite and permanent, that just means that indefinite means it could go on forever, but won't necessarily. So just because, the point we're trying to make is, just because we say indefinite lives, that doesn't mean you're done looking at that asset forever. It just means that for now, you're not going to recognize any depreciation because you don't see any foreseeable loss in value in the future. I left this slide in here, and I'm actually kind of changing my mind now. Partial year depreciation. Again, once you, and obviously a lot of you are in tax, so you have or will see this there. But I don't really like to talk about partial year depreciation outside of tax. So I'm not going to talk about it in immediate. Again, this is one of those subjects that, at most you may have one question about this on the CPA exam, but it is within the study materials that you'll get for most any study course if you purchase one. And definitely something that you want to have seen before. So take a look at it. Again, I'll try not to test on it myself. We'll move on from there on the partial year stuff. Okay, changes in accounting estimates. Typically, we will account for these prospectively. Okay, so when a company revises a previous estimate based on new information, typically you're not going to restate prior year's financial statements. Instead, the company just incorporates whatever the new estimate is from that point on. So it usually ends up affecting some aspect of the balance sheet and the income statement or the income statement. And then basically you would just throw a disclosure note into the financial statements explaining the scenario. So this is a couple of special cases, depreciation, amortization, and depletion method changes, where you have an accounting estimate change, but you have to change an accounting principle in order to change the accounting estimate. So basically you need to know, okay, do I treat this like a change in estimate, or do I treat this like a more significant change in principle? So basically we're just going to treat these like we would for any other change in accounting estimate. So it's not going to be, even though it kind of looks like on the face a change in accounting principle, it's not going to be treated as strictly as such, and going to be afforded the less strict treatment, and we're going to be allowed in these cases as well to treat it prospectively and adjust it from that point forward. I should mention that as well, that having said that, it does require a clear justification as to why the new method is the preferred method. Here's an example of what that might look like. You can't see it, but the credit side of this entry is accumulated depreciation for $20,000. Sorry, I cut that off there. Again, just didn't want to end and have to restart the slideshow. So yeah, I'll just call it out if I see one that you definitely should pay attention to. Okay, so when we're accounting for errors, first of all, we need to decide whether it's going to be a material error or not. Okay, and basically, we've talked about materiality before, but that's going to change based on the size of the company and some other factors as well. But assuming that you make the designation that you've encountered a material error in the previous recording of financial statements, you then have to go back as far as you see the error and make changes wherever the changes need to be made and correct the correct account balances. So if you end up having to mess with or change retained earnings, that would go down in the prior period adjustment. Then, of course, you would want to document that in the notes of the financial statements And the bottom of that slide says impact of the correction on income. Again, you can take a look at the illustration on your own there. Credit side at the bottom there is $180,000 to retained earnings. Sometimes you have assets that are impaired in value. Obviously, when you're estimating something such as useful life, you could be wrong, and for whatever reason, the value could change. For example, building destroyed by fire before depreciation happens. In that case, you would look at the remaining book value of the asset, write that off as a loss, and then you're going to look at whether, as far as the impairment loss goes, whether or not the assets are going to be held and used or held for sale. Held and used, then you write them down if there's been significant impairment of value. There's an example of that. Okay. So again, for assets to be held and used, even if the significant impairment of the value has occurred, that doesn't always mean that you're going to know exactly how impaired it is. You may just know from a magnitude standpoint, hey, it's pretty impaired. But again, still might see some difficulties in determining how much that is. Alright, you can take a look at the guidelines there for held and used for the different categories of assets that we've been talking about. Yeah, I don't even really want to talk about this slide too much, other than when to test for impairment. So for these types of assets, equipment and finite life intangible assets, only when generally there's some type of event that's happened that indicates it's likely you're not going to get the book value back of the asset. So again, this could be like a burglary, someone steals your stuff, natural disaster, any number of things that cause this to happen, or just it broke, or you crashed your car and a bunch of tools broke, or something like that. Anything like that. These are just kind of some red flags that may trigger or should trigger a thought in your head, hey, maybe I should take a look at these to see if they're impaired. These are the steps that you take in determining whether an impairment loss has occurred and when you are reporting loss. If a loss is recognized for impairment, the written down book value becomes the new cost base for future cost allocations. So again, basically, once you change the value of the asset based on the impairment, you would then go back and recalculate depreciation starting from that point on. Okay, from today, what's the remaining useful life? What's the current value to be allocated? And start fresh from that point. So when to use undiscounted and discounted estimates of cash flows should show you there, or does show you, I guess. Conservatism at work in the accounting profession. Doing it that way ensures that you are making impairment judgments in the most conservative way that's possible. You can take illustration on your own. The credit side at the bottom of this journal entry that you can't see in the screenshot here is factory assets, and you would credit that for $165 million. So indefinite life intangible assets that are not named goodwill should be tested for impairment annually, and then again follow that standard. If there has been some event that's suggestive that impairment would have occurred or could have been caused by the event, then you want to take a look at it. Again, bottom bullet point, once you decide it's impaired, a new allocation is used based on whatever the written down impaired value of the asset is at that point, using useful remaining life of the asset and whatever the salvage value might be at that point. I think we talked about goodwill a little bit last time. Obviously, it's a bit of a unique intangible asset because it's not really an asset specifically. It's more a catch-all of value that can't be tied to anything else. Let's see. So, a reporting unit, that's the level at which you should test goodwill. Meaning, you're not necessarily going to test overall company goodwill in terms of whether it's impaired. You rather will test at the reporting unit level and then obviously aggregate the totals together, showing you a total of what the overall effect on overall goodwill would be. Excuse me. Last line on this slide says the book value of the goodwill over its implied fair value. So this is the two-step process for measuring goodwill impairment. Again, probably should take a look at the PDF versions of these slides so you can see the full slides, and this might be one to bookmark in case you run into any goodwill questions. Okay, so when you have to test for goodwill. Well, I'll just let you read that slide. Basically, at this point, you have the option of performing a qualitative assessment to avoid step 1 of the test, but it has to be done once a year. Okay, never mind. You can just look at the slide, the PDF version. Okay. Take a look at that, talk a little bit about assets to be sold. This just means assets that you, as a company, are going to get rid of. Let's see. You can take a look at that, just more of a resource slide again. Let's see. Actually, that's about as far as I wanted to go in the presentation. There's a few more slides. You can take a look at those on your own if you want. But for now, we're going to go to this point and together. A couple other notes. I think I mentioned this a little bit, but I did post some practice questions if you want to take a look at those in Connect for this class and for tax. I'll do that and try to do that for each chapter. I've tried to post a little bit into the future, so If you want to work a little bit ahead, you can, and I'll try to work that even further. If you have any questions, let me know. Text, email, whatever. I would recommend... Oh, the other thing I was going to say... So I've actually decided not to do the quiz-like questions for my upper division classes. So the reason behind that is... well, the reason I started doing those in the first place was for my principal's level classes, and then it kind of just spread to the upper division classes, and I ended up doing it just to be uniform. But I've been thinking about it, and I think it actually does you a bit of a disservice at this level, because you're not required to think as deeply or analytically about the questions or about how you need to go about answering them. So I'm going to stop doing that. Instead, what I'm going to do, I'm going to try to incorporate a few more examples into the lecture of just general examples each week. And then on top of that, if you want to practice or look at practical questions, look at the practice questions, try to work them on your own. When you run into trouble, if you can't do it on your own, obviously the best case scenario is you've read the chapter, you can do it on your own instantly, and you need to waste time watching me walk through it. If you get to it in the practice and you can't do it on your own, having read the chapter already, let me know about which question it is, and I will specifically walk through that particular question. If just looking at the answer when the computer gives it to you is not enough, and I can give you relevant examples to look at to help you understand the concepts, and then the quizzes will also, even if you haven't seen that exact example, help you to learn as you go. So I hope that makes